Welcome to your Profitable Law Firm podcast. I'm Kelly Brubaker, your dedicated host, passionate about empowering law firm owners. Let's dive into the hidden strategies that lead to overflowing profits, scaled growth, and thriving lives. This is where overwhelm transforms into confidence, enabling you to create and enjoy your dream firm and your dream life. Welcome back to the podcast. So the one thing that's been on my mind a lot lately is income taxes. And no, I don't love income taxes. I do believe that we do need to pay fair income tax. I don't agree with how the tax is spent pretty much at any level of government. But that's not what I want to talk about today. What I want to talk about and why this has been on my mind is I've been talking to a lot of clients and prospective clients over the last couple of months, just because it's been tax filing season, about tax returns. And a lot of great questions. And through these conversations, I've realized how much I take for granted being a CPA, that a lot of people don't understand. And so I'm hoping to be able to share some insights with you today. So the federal form 1040. Here's a couple things that I just want to talk about in general. So your form 1040 is due April 15th. There's a rule that if April 15th falls on a Saturday, a Sunday, or a federal holiday, or a holiday in Washington, D.C. when the IRS offices are officially closed, then the return is due on the following business day. But here's the good thing. If April 15th is too fast for you to get your return done, you can easily file for an extension as long as you file the extension on time, meaning before midnight on April 15th. It's automatically accepted and gives you another 6 months to get your return prepared, which would then put your due date at October 15th. And again, same rule applies that if October 15th falls on a Saturday, Sunday, or a federal or Washington, D.C. holiday and the IRS offices are closed, it's due the following business day. And there used to be, I remember, now I was in college in the early 90s, and I even remember this when I was in high school, that as I talked to different people about pursuing a career in accounting to be a CPA, there was this big rumor, and it's persisted for a really long time, that if you file an extension, you're now on the radar of the IRS and that you're going to get audited. And I have to tell you, I graduated college in 95 and I started working before when I was in college in the accounting profession. And that is absolutely not true. Filing an extension is 100% legit, not going to pop you on any radar to get audited. The things that get you audited are filing false numbers on your return or filing returns that don't jive with the other documents that the IRS has collected from businesses that you've done business with over the last year, meaning your W-2, your 1098 for mortgage interest, stuff like that. If you file on your return numbers that don't equal the other tax documents the IRS has received copies of, then yes, you get audited. The initial audit that happens is called a correspondence audit, meaning it's an audit by mail. And literally you get this letter, it's called CP 2000, that goes through and says, hey, we updated your return because we looked at the documents that companies filed tied to your social security number, and we compared it to the numbers you filed on your 1040 and they don't match. So here's what we are proposing to revise your return to. If you agree, do nothing, we're done. If you disagree, now you need to write back to us or call us and provide documentation of why our revisions are wrong and how you filed your return is correct. That's a form of being audited. So filing for an extension is not bad. It's absolutely necessary. And I will tell you, as someone who has spent time preparing tax returns over the years, right now, there are less and less, especially since COVID, people who are working to prepare and file taxes. but we have more people that need to file tax returns every year. So let's do that math. And now there's a shrinking availability of service providers who prepare and file tax returns, which means each preparer who is still actively preparing returns is just seeing a natural influx of business, and they're having a hard time getting staffing to help prepare all those returns. If you have a tax preparation office and normally one person prepares 300 returns a year, all of a sudden they may have 400 returns this year and no additional help. They're not going to be able to get every single return done by April 15th. Some of those returns, if you want to use that preparer, have to go on extension. And the reason why I'm sharing this is because between prospective clients and clients that I've talked to, I've had these conversations where people are extremely upset, very angry that their tax preparer could not get their return filed on April 15th. And my response is, if a professional tax preparer says to you, please let me extend your return, that is the polite way of them telling you they don't have the time or the mental capacity to be able to dedicate enough to get your return correctly and accurately prepared and filed by the 15th. So please, if you have a paid preparer and they ask you if they can file an extension for you, say yes, please, unless you have one of the very, very few situations where you have to get your return filed by April 15th, please take your tax preparer up on that offer. And this is why, because it lets them get through the most critical returns that have to be filed by April 15th, and then they can relax. And that doesn't mean wait until October to file your return. It just means it gives them breathing room that they can actually sit and focus on your return. And in all honesty, if I'm going to pay somebody to do my tax return, I don't want them rushing through the numbers. I don't want somebody to work on my return who has just spent 10 hours working on 10 other returns today. I'd rather somebody take their time and go through my return and do it correctly. So I mentioned that there are situations where some people have to get the returns filed by April 15th. Those would be, and I'm sure this is not an exhaustive list, but these are the only two situations that come to my mind. And that's if either you're going to file for bankruptcy, because part of the bankruptcy filing hinges on getting your most recent return filed. Well, if you're in March or April of the current year, the first thing they ask for is the last tax year, the most recent tax year, I should say it that way. So if we're talking about being in real time in April of 2024, then your 23 return needs to be filed so that you can get your bankruptcy filing submitted. The only other thing I can come up with as a situation is if you're trying to get a mortgage. And because once you get so far into the year, your mortgage lender wants the most recent tax return. So the further you get into 2024, they're really going to push you to get your 2023 return filed so that they can use that as information for the basis of giving you a mortgage loan. So those are the only two situations. Now, again, there could be many other situations that just haven't crept up into my world that are valid about needing your tax return done by April 15th. But if you really don't have a third party pressing on you to get the return filed and you have a paid preparer who's asking, please say yes and let them take that time and a little bit of relief to not have to rush through your return. Because what happens when we rush through stuff? Mistakes happen. And at the bottom of your return, when you sign it, when you give permission to your tax preparer to e-file that return, you're also agreeing that you're filing under penalty of perjury, that everything in your return is accurate, and you are also taking responsibility for the numbers, even if you paid somebody else to prepare that return. So again, please don't think filing an extension is a red flag. It's not. So now that I got through that, here's what I want to do. I want to go through and just talk through this. Now, if you're watching on YouTube or if you're listening on Spotify and you set up Spotify to show the video of this podcast episode, you'll be able to see on your screen the Form 1040. If you're listening anywhere else, you can still hear me, obviously, but you won't be able to see the Form 1040 that I'm going to talk through. But I just want to go through pages 1 and 2, because whether your tax return is 2 pages, 10 pages, or 100 pages when it gets printed, depending on the complexity of your return, every page after page 2 is doing some type of gathering of information, a calculation that arrives to a number, and that number appears on pages 1 and 2. So let's just go through step by step on Form 1040. So page 1, it starts off at the top where it's collecting. It definitely has printed on it. It's for which tax year it's for. And then you need to make sure that your legal name, first and last, is on your return, and your social security number is correct. If you have a spouse and you're filing a married joint return, make sure that their legal name, first and last, and social security number is correctly on the return. Sometimes, if you've recently been married or recently divorced, or for whatever reason changed your legal name, and your tax return, the name doesn't match the social security number that's on file with Social Security Office, the IRS has access to that information. They'll reject your return. So it's very critical that your first and last name and social security number match. I typically don't, whenever I've prepared a return, I've never included middle initials, because I had a horrible time one year where I included kids' first name, last name, plus middle initial. And one of the kids, the middle initial was wrong and the return rejected. And it just caused me all this trouble. Now, home address. The address that you use should be a valid address that you can receive mail at. I will tell you that I know people who have multiple homes, and when I ask them which address to use, they give me their preferred address. Totally cool. But if you perhaps have a home in Ohio and you have a home in Florida, and go further with that you're only in Cleveland 2 months a year and you're in Florida 10 months a year, and you're legitimately a Florida resident, please don't put your Ohio address, because the IRS makes available to all the states who have state income tax. The states can, and they do, contact the IRS and get automatic data feeds of which returns were filed with the IRS that had an address on the Form 1040 for their state. They do that with the assumption of, if you use that address, then that must be your residential address, and you're admitting to the IRS and therefore to that state that you have a filing requirement for that state and a tax obligation. So in my situation, where I talked about living in Ohio for 2 months and Florida for 10 months, Florida doesn't have state income tax. So Florida doesn't contact the IRS, and there'd be no correspondence from them. But Ohio, just like a dog with a bone, Ohio is now going to contact you if you use Ohio address and say, why didn't you file with us? And oh, by the way, because of what you filed with the IRS, the information we received from them, here's your tax bill. And they're going to compute, then it's going to be some insane, ridiculous amount, because they're going to want to get your attention. The problem is, if you ignore them, that becomes a pretty painful thing to fix if you ignore it, because it'll eventually go to the Attorney General for collection, and it can show up on your credit report as unpaid taxes. It can cause you a lot of pain. while you can put whatever address you normally get your mail at, I heavily suggest you use the one that you live at a majority of the time that is tied to your residency. To even dig further, and I know this part because I live in Ohio, I'm a lifelong Ohio resident. We have city income tax or municipal income tax. And if you don't live in Ohio, and there's only a handful of states that also have city or municipal income tax, you might even be aware of this because of a recent court case. And I think it was the Chicago Bears. So NFL professional athletes, because they play in how many cities every year, the Cleveland tax agency was trying to pursue collection from professional athletes who had played in town. But of course, the professional athlete's going to argue, I don't live there. But the way that the city income tax rules are written, at least in Ohio, I don't know if it's the same in other locations, but at least in Ohio, it says you owe city income tax where you work and where you live, both places. So there's people that I have done returns for in the past that have paid more in city income tax to multiple cities because they work one place and live in another, and they have to pay tax to both of them. They pay more in city tax than they do to the state of Ohio for state income tax. So address is critical. Just wanted to point that out. So after you fill out your name, social, and address, the next thing is there's a box that says presidential election campaign. Check here if you or your spouse, if filing jointly, want $3 to go to this fund. Checking a box below will not change your tax or refund. I've done thousands of returns over the years. I've never had somebody volunteer to check that box, but if you are so inclined, then that's your option to do. So after that, the next thing is filing status. Now, there's a lot of flowcharts online, and it's something that if you talk to your tax preparer, please don't just follow last year. Go through the flowchart to figure out what your correct filing status is. So the options are single, which means you're not married and you have no dependents, or head of household, which means you're not married, but you do have dependents. There's married filing a joint return, meaning both spouses are going to report everything of theirs on one return. Married filing separate, which is you're married, but both spouse, for whatever reason, sometimes it's tax saving, sometimes it's separating out the tax liability, will want to file separately. Or there's qualifying surviving spouse, so a widow. It is critical to get the correct filing status because the tax brackets are different for each filing status. If you have any questions, definitely make sure you either go through one of the flowcharts that's available online or talk to your tax professional about this. So, relatively new question that appears on the returns now is asking you about digital assets, meaning primarily cryptos. And on the return, it's just a yes, no question. But in the program, like in the tax preparation program, answering yes prompts additional questions. Answering no bypasses those questions. And essentially, it's more of a reminder question because what's happening, and I actually just learned this a couple weeks ago, while you may have a brokerage account, you may buy and sell mutual funds or stocks on the stock exchange. Those brokers will send you a 1099-B if you had any sales during the year, or it'll be a combined 1099-B if you had dividends and interest on those investments. But what I didn't know that I just learned is that the cryptocurrencies do not always provide you a statement. And some will give you a 1099-B for a brokerage statement. Some will give you a 1099 miscellaneous or a 1099 NEC. I did encounter one person I talked to this year who said, I didn't get any forms from my crypto. And I don't remember what the crypto was, but they didn't get any forms. And so they had to dig through all of their transactions for the whole year and come up with the numbers needed, because that's part of your capital gains, is to report your sales. So next would be your standard deduction. And first it starts off with, can someone else claim you as a dependent, or your spouse if you're married? And this is because, and I've seen this happen so often over the years, college students work a job, or even high school students work a job, get paid a couple grand for the year. They had some income tax withheld, some federal income tax or even state income tax, and it's maybe $100. And somebody says to them, hey, file your 1040. You didn't make enough money to owe tax. So if you file a tax return, you'll get that $100 back as a refund. And so they go and file their tax return, and they check the box saying that nobody can claim them as a dependent, which is not true, because they're still dependent on mom and dad at that point. And it screws mom and dad, because now that the person has filed their own return and claimed themselves, the parents cannot claim that student as a dependent, which, if it's a single parent household, might kick them out of the head of household status and into single, which is a higher tax bracket. So it's important that you answer, this question: can someone else claim you as a dependent, or your spouse? Then, if you were born before 1959, you get an additional amount added to your standard deduction. Same thing for your spouse. And if either you or your spouse are blind, there's an additional amount that gets added to your standard deduction. So make sure that you answer those questions correctly. And then the next part is dependence. Now, initially, the default thinking through this is your children. So any of your children, and you list them out: first name, last name, social security number, and then you have to define their relationship to you. But here's the thing: dependents don't have to be your relatives. They don't have to be your children. So definitely talk through or go through the flowcharts to determine who is a dependent for you. Because depending on who they are, how they're related to you, and their age, you may qualify for other tax credits for those dependents. So that's critical to get that correct. So now here we get to the meat of your 1040. The top half of page 1 is just information gathering. And so once we get into the bottom half of page 1, lines 1 through 8, which is really like 20 lines, is trying to gather all the different sources of income that you had during the year. So any source from anywhere, any income, trying to gather all that information. And depending on the type of income it is, it gets listed on a specific line. And that's important because stuff like Social Security benefits, the amount that goes on line 6B, to compute that amount, you may get $5,000, and that's below the threshold of your total income. So you have to report it as coming in on 6A, line 6A, but on line 6B, it's 0. And if you took a rollover from a retirement account last year, then you at least have to report on line 5A what the amount of the rollover was, but the taxable amount that goes in 5B is 0. So again, lines 1 through 8 on your 1040, just trying to gather the different sources of income. And then depending on what your answers are, it may limit or tax differently. So like line 7 talks about capital gains or losses, and there's a different tax computation for capital gains versus ordinary income. So once you get through and get all your different sources of income added up, line 9 is your total income. And then line 10, there are 3 schedules, which I think equates to 5 or 6 pages of different items to adjust your income. And adjustment is very critical to understand, because some of the things are adding to your income and some of the things are subtracting from your income. Things that would go on line 10 would be things like if you made a contribution to your HSA, or if you made a contribution to your IRA. So those are the things that would be captured on line 10. So once you have your adjustments, your total adjustments from the schedules 1, 2, and 3, you add those totals up, put that amount on line 10. And now you're going to take your total income and subtract off your adjustments. And that gets you to line 11, which is your adjusted gross income. And so I'm going to put a pin in that number. And then we go back to whether you're going to take a standard deduction or itemized deductions. Now, standard deductions are pretty high. So depending on what your filing status is, the IRS gives you some amounts for a standard deduction. For example, single or married filing separately, your standard deduction $13,850. If you are married filing jointly or you're a qualifying surviving spouse, your standard deduction is $27,700. Head of household, $20,800. So you have to take those numbers I just gave you based on your filing status and compare it to your itemized deduction. Well, what can you itemize? Depending on, everything has limits. So medical expenses, but it has to be more than a percentage of your income. So you have to have really had significant medical expenses. You can deduct state income taxes or state sales tax, depending on where you live. You can deduct real estate taxes paid on your home that you own. You can deduct mortgage interest on your home, your charitable contributions, and there's limits to that as well. But by completing Schedule A, you'll get an amount for total itemized deductions. And if your itemized deductions, you take whichever is the bigger number, the standard deduction or the itemized deduction. So take whatever of those two numbers, whatever's the bigger one, that's the one you put in line 12. And then if you own a qualified business, then you get to reduce your business income by 20%. And that deduction goes in line 3. It's called Qualified Business Income Deduction, or QBI. And this is something that's been around for, I don't know, about 7 or 8 years now. I forget when that went into effect. So we're now going to take your adjusted gross income from line 11, subtract off your standard or itemized deduction. If you had a qualified business, then we would subtract off that deduction as well. And it gets you down to line 15, which is your taxable income. So line 15 is critical because this is going to be the number that is used when computing your income tax due. Now, I say that, and there's like a little asterisk behind that sentence, that line 15 is the number used for taxable income to compute your tax due, except if you had capital gains, then whatever amounts on line 7, that goes through that's excluded from the calculation and has a different set of math that's done. And so then the math done on line 7 plus the amount on line 15 gets you to total tax. So when you go to page 2, at the top of page 2 talks about line 16, just starts right off with the total tax. Behind the scenes, the computations happening for capital gains tax plus. Then in the tax and credit section, which is line 16 through 24, is going through and any tax credits that you are eligible for. And the most common ones I see are child tax credit. So if you have a kid that's 17 or younger, as of the last day of the year, child tax credit. And then the other one that I see a lot of times is if you have investments held at a brokerage company that invest in foreign stocks, and you paid foreign income tax through those investments, then you get a credit. The IRS says, oh, if you pay $100 or whatever it is to $10,000, whatever you paid for foreign investments, we're going to reduce your tax bill for that. So you get a credit for that. And then, so it goes through the credit part first, which credits mean it's reducing your taxes that you owe. And then line 23, if you own a business and that business is either a Schedule C or it's a K1 from a 1065. So a multi-member LLC or partnership or a sole proprietor. So Schedule C or 1065. If you have income from those sources, then self-employment tax applies. And then that gets added in on line 23. And so now we went from the initial calculation of your tax, subtract off any credits you're eligible for, and then add in self-employment tax if that applies to you. Now we get to your total tax. That's line 24. That's the worst number on your return, is line 24, the total tax due. From here, we're now going to start going through and determining how much income tax have you already paid. Because in the US, regardless of what jurisdiction you're in, whether it's the IRS or your state or local, all tax, for the most part, and I know that there's a couple exceptions to this rule, but for the most part, 99% of the time, payments for tax are to be made in real time that you are incurring that tax liability. Meaning, you earn income today, you should be within a week or two, you should be paying the tax that you owe on that income. This is why when you have a paycheck, you get gross wages, subtract off state income tax withheld, or federal income tax withheld, state income tax withheld, and any other taxes come right out of that paycheck, because you just earned money and then they're going to withhold. Your employer just does it automatically and withholds the money, sends it to the IRS or to your state. So now that we know the total tax we owe, we're going to start deducting off, okay, how much did you pay already from your W-2s? If you had 1099s where somebody withheld tax from you, from your earnings, let's get that added in. And then any other sources. Did you make estimated tax payments through the year? Because depending on your income situation, your paycheck may not withhold enough and you may have to make additional tax payments. So how much did you pay in estimated tax payments in the year before? So if we're on the 23 tax return, did you have a refund in 22 that you said, no, IRS, keep that money, keep that refund, even if it's a part of that refund, you keep it and apply it to my estimated payments for 23. The middle third of page 2 is just trying to capture all the sources of payments. And then there's additional credits that you may be eligible for. Those would all be here reflected as reductions, or they'd be reflected as payments. I should say it that way. And so that'll get you to your total payments on line 33. Now, what I'm showing on the screen, it's a blank 1040. So there's no numbers that appear on here, but a lot of times I'll have questions like, why last year, my income from last year and this year were the same, but why was it last year I had this huge refund and now this year I hardly have a refund at all? Why? Because I was expecting that huge refund the same as last year. Because the IRS went through and revised the withholdings. They went back to every payroll program and every employer early in 2023 and said, hey, we see a history of too many people getting these huge refunds, and we're going to try to better match the amount that comes out of your paycheck to how much you actually owe. So we're trying to reduce. So the IRS actively was trying to reduce how much withholdings they were receiving during the year so that they had less refunds to pay out at the end of the year. And that was to give you more money in each of your paychecks. So it's not that you got screwed. It's just the timing. You had more money coming in your net pay throughout the year of 23 than you did in 22. So you have less of a refund. And that if you owe, it's because you didn't pay. You had income that you didn't pay tax on through the year. Either you didn't have money withheld out of your W-2 or 1099 at the right level, or you didn't make estimated tax payments. And so you didn't pay it throughout the year. So now you owe it at the end of the year. And that's how you get to your overpaid, your refund, or the amount you owe. When I started this, I had a whole little section that I talked about with filing an extension. Filing an extension, that means that you are requesting additional time to file your return. You're asking for another 6 months to file the return. That is not an extension to make the payment of the tax that you owe. During 2023, you should have paid either estimated payments or through a paycheck or a 1099. You should have been making payments throughout the year. You should have made, if you were making estimated payments by January 15th of 2024, you should have made a payment that all of those payments added up together should have paid substantially what you owe for the year. Now, depending on the nature, income could fluctuate and you may not know. So you get one last chance, which is the whole point of why we do a tax return. Because the tax return is you putting together a report that tells the IRS how much income you had, computing how much you owe them, showing them how much tax you already paid them, with how much you have left to pay or how much you overpaid and they have to refund it to you. So if you owe on your 1040, then you're going to have a tax penalty. And it's based on time. So the longer it takes you to file, the bigger the penalty is going to be. But the penalty, it's a couple percent. It's not a huge amount usually. Where I see people get into trouble is if they have a substantially large balance they owe with their 1040, and then they purposely drag their feet until October to file, and then that starts to become a big number. If you get to where you get through the return, whether you prepare it on TurboTax or whatever software, or you have a paid preparer that you use, if you cannot pay the full amount that's showing, then immediately contact the IRS and set up a payment plan. Depending on the amount, you might even be able to do it online, because the IRS has on irs.gov, there's a whole section on payments, on payment plans. And some of this stuff is just automated. You can just go right on and do it. I can't pay it all in full. I'm proposing a payment plan of X dollars per month for X number of months to be able to get the whole thing paid off. And then the IRS will contact you and say, we received this request and we approve it or decline it. If they decline it, they'll give you information like on next steps. And basically, if they decline it, it's because of something. I would say it's because the amount you proposed over the time frame is not enough to pay the tax that you owe. So as long as what is proposed, like if you owe $50,000, but you propose 12 payments of $100 a month, the IRS is going to say no. $1,200 is not sufficient to pay off $50,000. They're going to reject that. And they're going to come back to you and say, thanks, but play again. We need to figure out a real payment plan on this. But as long as what you propose, if you owe $1,200 and you go to the IRS and say, hey, can I pay $100 a month for 12 months? They'll say yes. So as long as, actually, they might say no. They would probably want like $110 a month because there'll be some interest and penalties that accrue. So as long as what you propose as a monthly payment for an amount of time, and the IRS has 10 years from the date you file a return to collect that money. So as long as whatever payment plan you propose will get that amount paid within that 10 years, then they'll accept it. So just to finish out the bottom of page 2, you can, once you get to where you owe or you have a refund coming, and it's important that if you have a refund and you want it direct deposited to a bank account, that you get that information and put it in there. Because once you file a return, you cannot go back and add direct deposit information. So if a return gets filed with a refund and there's no direct deposit information, you'll get a check automatically. And so the last couple of things, just to finish up the 1040 page 2, third-party designee. Did you have somebody that you want to give permission to the IRS to talk about your return? If yes, enter their name, phone number, and a PIN number, because that's how the person will be identified. When the person contacts the IRS to talk about your return, they'll have to validate who they are. And part of that is the PIN number you assign them on your return. And this is important for things like if you prepare a return for an elderly parent, then your parent would sign the return. And, it's their return, so they would sign it, but they could designate you as a person that's authorized to talk to the IRS on their behalf. And that'll help you if there's any questions down the road with that return. And then you're going to sign, which in today's electronic day and age, whether you use TurboTax, any online program, or you have a paid preparer, you actually will be signing a form 8879 that gives the preparer permission to e-file your return. And so this disclaimer is on that form also. But if you file the 1040 yourself, then you would just sign right here on page 2. So sign here. Now get this. Under penalties of perjury, I declare that I have examined this return and accompanying schedules and statements, and to the best of my knowledge and belief, they are true, correct, and complete. Declaration of preparer other than yourself as the taxpayer is based on all information of which preparer has any knowledge. There, 2 pieces put in there, and it's a statement that you are signing. You have to sign it or your return does not get processed. You and your spouse, if you file a married joint return, but it would sign that you agree to that statement. And then if you had a paid preparer, they would sign the return, and they're agreeing that they prepared the return to the best of their knowledge based on everything you gave them, that the answers to your questions. The paid preparer information is very critical because if you did pay somebody to do your return, the IRS is collecting their information because the IRS will do trend analysis on returns filed by preparer. And so that's how, and I don't know where you live, but I know so I'm in Akron, Ohio, just south of Cleveland. And a couple of years ago, and I think this was like maybe right before COVID, there was a company in Akron that was a substantial size business that prepared tax returns and did bookkeeping and payroll for companies. And oh, by the way, they were running payroll, but collecting the payroll tax from the company, their client, but not always sending 100% of that off to the respective payroll companies, tax agent. Eventually that got busted, but the information that's put on here on each return about paid preparer let the IRS go through, or even the state of Ohio or whoever the agency is that starts the investigation, they can use that information. So there's P10, which is your preparer tax ID number, or the firm's EIN. It lets the tax agencies then go and compile. So if they see something that's completely not correct, that's fraudulent or potentially fraudulent, they can start pulling all the other returns that same paid preparer was listed on, and they can start doing investigations from there, and it can blow up pretty quick. So this was a lot of information and probably one of my longer podcast episodes. So I do apologize, because who really wants to talk about taxes? But I just feel like I said when I started out, there's a lot of conversations I've had between clients and prospective clients over the last couple of months that has really revolved around not understanding a 1040, because, nobody ever sits you down in this day and age and says, this is what happens. It's more of the, hey, you need to file a return. And you're like, oh, okay. And paid preparers just don't have time in tax season to sit down and take the time to discuss stuff with their tax clients. Hopefully this was helpful for you. If you have any questions about today's episode, feel free to comment if you're watching on YouTube, or send me an email to podcast@profitscalethrive.com. If you know someone who might need to hear this information, please share this episode with them, or if you're on YouTube, tag them below. Be sure to follow and subscribe to get notifications for future episodes. Did you enjoy this episode? Please consider leaving a review. And before I go, remember, profit is something you intentionally plan for in the beginning. It is not a potential bonus at the end of the year. Thanks, and have an amazing day.